Welcome to the Big Mike Fund podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic. Starting now.
Welcome to the Big Mike Fund podcast. I'm the Big Mike.
Mike Zlatnik, and today it is my pleasure and a privilege to welcome back Charlie Dobens. Hi, Charlie.
Hello, Michael. How are you?
Thank you for coming back on the podcast. How have you been?
Very well. Very well. I was just commenting before we went on air. Like, geez, Mike, you look great. You look like I said you lost weight. You cleaned up your act, Mike. I mean, what's going on with you?
I appreciate that. Yeah, I've lost a little bit of weight. I'm working on that, making progress. So thank you.
Good.
Kind
Good for
words.
you.
And you look great too. And
Thank you.
but we'll skip the pleasantries. Let's dive straight into the what's going on in the world of multifamily and basically you're an attorney, practicing attorney, doing many things with many folks. Let's talk about what are you seeing out there? Where is your work concentrated today? What is the exciting stuff, good or bad?
All right. Well, I mean, there are really two areas that we're seeing in this business right now. Because, as you know, the transaction volume has declined on multifamily. There's a huge disparity between the bids and the asks, between the buyers and the sellers. I mean, just 2 years ago, the sellers were getting top dollar for their properties, and now they can't make the numbers work due to the interest rates. And of course, as we all know, interest rates have nothing to do with the valuation of a property, but they have everything to do with the cost of doing business. And so that's why we're seeing these prices are not matching up. So what we're seeing are two opportunities, two areas that we're moving into, which are maturity defaults, which I'll explain in just a moment, and also converting hotels, existing hotels, into multifamily properties, and thereby really just changing the asset class of the property. And by doing that, you change the cap rate. So those are the two areas that we see opportunity in. This I can talk quite a bit about maturity defaults. As an attorney, my clients contact me over issues they're having with their lenders. Dealing with one right now with my client didn't even know that the property was being placed into a special servicer and was becoming a troubled asset with the bank. But the problem we're seeing right now is that it's as one person said on in Globest the other day, Mark Silverman of Lock Lord Partner said that what's happening now is really just a timing issue. And I could not agree with him more. The problem is that there were so many transactions done back in the late teens that if there were 5-year terms, they're now coming due, and they're coming due at a time when the interest rates are extremely high, valuations, the cap rates have gone up, the properties have lost value, and they just can't make the numbers work. And therefore, kind of like back in the old 2008 days, where the banks were just kicking the can down the road, they were extending and pretending. We're starting to see more of that in the industry right now, where the lenders are extending the maturity dates so that these properties that are defaulting at maturity can have more time to get back on their feet and figure out a solution, because the banks don't want to take them back.
Yeah, I appreciate that wisdom. In general, I concur that most of the banks don't want them back, but they do want to arm twist a little bit. So maturity cliff was the term, maturity wall was the term, and absolutely maturing loans from 5 years ago that were financed at meaningfully lower rates today can't really refinance at the current rates. And especially if you look at debt service coverage ratio, hard to meet, right? And then LTV is also questionable. So what solutions are you finding? So you got two types of maturity defaults in a manner of speaking. One, let's call it term maturity, right? The other one becomes, are you seeing bridge loan maturities, which is a little different beast, but it's the same kind of a problem where these loans, well, a few categories. So term maturity on a fixed rate debt, sort of a term maturity on a bridge loan from a few years ago. And then I've seen another thing that's been aggravating banks. They basically don't like debt service coverage. You have some kind of provisions, default based on covenants. So they are getting agitated with something, debt service coverage ratio being one of them, that they want the borrowers to bring some more cash to the deal, right? And that's the ultimate solution. What do they want? They want the borrowers to de-risk bank's position, bring some cash, put it in escrow, pay some down. And how are you dealing with these situations?
That is exactly how it works. I mean, the banks, you're dealing with two types of banks. You're dealing with what I call Frank's Bank, which is your local lenders, and then you're dealing with the Fannie Mae's and the CMBS loans, which is a totally different beast. But as a matter of fact, that was one of the issues I just saw creep up where, the client, obviously, if it's a CMBS note, they're getting reports every single month, and they're reporting to the GSEs on how the property is doing. As soon as the property triggers a debt coverage loan covenant breach, then that's when you see these banks start to put them on the watch list. And when they go on the watch list, that's when it triggers a lot of a notification among other investors. I mean, that's when you start to see the vultures start to go in and go after those properties. But I mean, I tell you, I had a situation back in 2008. I had just closed on a large multifamily property, and then Fannie and Freddie filed for bankruptcy, and the world changes overnight. And I held on to that property for, let me see, 7 years, 7-year term. And by the time I got to that maturity, the property hadn't come back. It had not come back in value. And in those days, I sat down with the bank. The bank came out to the property. We sat across from each other. I said, guys, I just need more time. I just need more time. And I know I can make this thing work. I haven't missed a payment. I'm running this property beautifully. It's just the value has lost. Just give me more time. Now, remember the guy just sitting across from me in the office, very matter-of-factly saying, no, that's not how we work. We just take the property back. I'm like, no, we just need more time. We just shake hands and part friends. No hard feelings. That's how it works in the CMBS world. I'm like, wow. Okay, well, thanks very much. There goes everything. And we moved on. As opposed to today, when I just mentioned, I'm now starting to see some of these dust lenders, some of these servicers coming up with creative solutions so that they don't have to do that. And if they have a good owner who does have a lot of capital, then they're willing to work a little bit on the loan and help the guy out. Otherwise, they're just taking the properties back like they did in the past. But now, I mean, in the past, there was only one option. They took the property back. Now you're starting to see these people starting to get a little bit creative because they don't want to take them back.
Yeah, and understood. And what does the creative solution look like? I'm just curious. What are they saying? What options are they giving the borrowers today? Like, what are the viable solutions? And I think they all learn a lesson of the past. They really don't want to take those into REOs, and that's when the market really starts correcting. When they grab too many of those assets, that's when the real problem happens. Today, the reason a big market correction because the distressed inventories are not high, so they're vultures looking for deals. But these workouts with banks is what's sort of saving the market from going into meaningful correction. And what's really interesting is the fact that the Fed started to cut rates. I mean, we're recording this post Fed September meeting 24, and we know the rate's already moving in the right direction. So if you give it enough time, the market should start correct based on the cost of money, obviously interest rates. Right. So what are you seeing? What solutions the banks are open to?
Oh, well, I tell you what I've seen in this most recently are just extensions of the maturities, of the maturity dates. That's what we're seeing.
And what do they want for the extension?
Oh, Yeah, they do require in some cases a rate cap lock, which is, I mean, rates are coming down, so that's meaningless. In some cases, I haven't seen it yet, but I know in the past, like you said before, show us the capital. We need cash. Bring down that note. Now, if you're dealing with a Franks bank, a local lender, somebody that's not governed by the feds, but is more governed by the state bank regulators, yes, you're seeing that. I mean, I had to do that back in the past. We had to bring $250,000 to the table just so that one of our properties would achieve that 80% LTV and look good on the bank's books. And so that was one solution. The other one is the old AB loan, which is where you rewrite the underlying debt to be 80% of the new valuation, and that shortfall, that amount that you had to carve out, you put that in a separate personal note in the form of a B loan that stays kind of off the real estate books with the bank. And that's what you're seeing on local lenders looking to get creative. That B loan becomes a personal loan that is not secured by any real estate, but the real estate book looks really good because it's collateralized properly with the bank. So those are some of the solutions that you tend to see. But here's one of the biggest differences over last time. The multifamily business, the fundamentals are still very, very strong. The demand for our product continues to grow. The supply is still incredibly limited. The problem is obviously inflation, but what's happening is people are having to bunk up, and you're getting more income earners living under the same roof, paying your rents. You got to go up in the rents because inflation's impacting everybody. But the thing is, you're seeing some drops in vacancy, some increases in vacancy in certain markets, but they're not like they were back in 2008. So it's because remember back in 2008, I mean, I remember when the short selling bank fiasco occurred. I had to start competing against the single family homes as in the marketplace that I never had to do before. And all of a sudden I'm getting $799 for a 2-bedroom, 2-bath. And now you can go down the street and rent a 3-bedroom, 2-bath house for less than what I was charging for rent. And that was the problem back then. We're not having that problem now because we're not having that single family home fiasco like they did back then. So the fundamentals.
Yeah, that's an interesting observation. That's actually a really, really good point, that the short supply of residential housing, including 1 to 4 doors, because of that shortage, you have significant demand for multifamily. So that this is a sort of a substitution effect. And interesting about the family formation comment, that some folks can choose to get a roommate if you can't afford the rent. Oh, that's always been the case for big cities. That's kind of some folks can live with roommates and some folks can, but at the end of the day, if you can't afford an apartment yourself, then you find the roommate. At the end of the day, exactly. But now let's go back to the opportunity side. So banks are doing these workouts. Transaction volume is super low. Are you seeing great buys? Are you seeing that there are situations where the sellers just can't raise, or the owners can't raise enough equity to keep the bank at bay, and they're forced to do some kind of a distressed sale? It seems like it hasn't been really happening in volume. Everybody talked about this, but it's kind of like, is it ever going to happen?
Yeah, the thing is, it's going to be a lot more silent than it was in the past. I mean, these things are happening. I mean, obviously, this is a sales and marketing business. You've got to find the motivated customer, the motivated seller. Those are the people in distress. They're not going to advertise their distress. You've got to go out and find them, come up with the solution to their problem, and then you will be the salesperson that made the sale. And the best way to do that is, I mean, you look at Crexi. Crexi has some great information. We've just switched over our data analysis from CoStar to Crexi, because Crexi was really starting to provide data on the local banks, the smaller mortgages, the non-CMBS mortgages. You look at a CoStar, and okay, they've got all the the CMBS information in their system. Great. So does everybody else. That's easy to get. But when you look at Crexi went ahead and they're starting to go down and find the private mortgages. They're going to find the local lenders. You can do incredible searches on Crexi that CoStar doesn't even come close to, and that data is helping us find those deals before anybody else is. And so we can go in and find banks that are, if we find one distressed asset and we find who the lender is, we can do a whole search in that particular market for how many other multifamily properties does that bank have loans with. And then we can do a search that way. We can contact the sellers or the owners using that type of data. It's a lot easier that way to find, because everybody's going after the CMBS because everybody's got that data. It's the other data that really separates the wheat from the chaff, because that's where smaller, newer investors are going to find their deals.
Yeah, understood. So it's an interesting new tool. I haven't heard what it's called.
Crexi, Crexi.
Crexi. Got
Yeah.
it. Thank you for the education. We've been using CoStar, but that's first time.
You're a dinosaur, Mike. You're a dinosaur.
I know. I admit that fact. So now let's reverse the role. Are you working with existing owners that are they reverting to raising fresh capital, and how they're raising fresh capital to buy time? Are they doing mass debt? Are they doing secondary debt? Are they doing preferred equity? Because a lot of these deals, if you give them enough time, and the fundamentals, as you pointed out, are good, the time and the execution of the value add strategy, whatever that is, might solve all the problems. And the distress is not that severe. In fact, stress is really related to the interest rates. So it's not a fundamental distress. It's just a cost of financing, which will be corrected over the next, let's call it, year and a half as Fed executes their policy. So where are we gonna basically? Where do you see the opportunities in this environment? Is this in the deployment of preferred equity mass debt? Is this still looking for deep buys through the tools like Crexi, or is it something else?
There's one thing that I've seen that I am not a fan of are these debt rescue funds. These where these syndicators are now out raising more money to be a source of a debt financing. In a lot of cases, they're doing it for their own deals. They're taking money again to go bolster up their own deals. This is seen, you can actually follow it if you check out viceroyresearch.org. Viceroy Research is a very unique organization. They are short sellers. They go out there, find distressed companies, buy their stock short their stock, and then start monitoring how the business is being run, and then report on it. One of their biggest punching bags right now happens to be Arbor Financial. Arbor Financial is one of the biggest lenders as a bridge lender and as a DUS lender for Fannie and Freddie to value add multifamily properties, B's and C's. And they are a lot of their properties they've had to take back. And a lot of properties, you've seen a lot of these syndicators, like, remember that Apple's Way debacle where they took back 4 properties. That was Arbor Financial. But in their most recent report, Arbor report, they break down how these syndicators are using debt funds in order to bolster up their original deals. And essentially, they're using those debt funds to pay back Arbor, and Arbor will then rewrite the interest rate and extend the deal. So that's how some of these syndicators are keeping their deals going by essentially what they end up doing. And this was spelled out in the Viceroy report. Viceroy report was that they were the original investors will essentially end up with nothing, but they will be able to keep their property going. So that's what I'm seeing, and I don't like it. And I've yet to see any one of these types of debt funds really create safety for the original investors. It's really creating safety for their business, and hopefully giving these investors in the debt funds a great return. But I'm not seeing it, and the numbers speak for themselves.
Yeah, that's an interesting observation. And I do concur with the point of view that the new money as it's being deployed, and we do some of it on our own past deals. It's a conflict, right? If you raise the money in the past and you're raising the money now, but the priority is to obviously for the new money. It's kind of one of these funny situations where you certainly want to give these past deals opportunity to survive and to thrive. But in order to survive, they need liquidity, right? If they can't raise liquidity, capital calls haven't worked very well. So I don't know if you've seen this. Many people have tried, and they get very low participation.
Yeah.
So in absence of that, what do? You, as an owner of the property, you either run out of cash and turn the asset over to the bank, you go through a distressed sale and you get very little to original investors, or you take on fresh mezz or fresh preferred equity, and that dilutes existing investors, but it buys time and the opportunity to get the property to better point of time and point of performance. So as much as you have the right point that the mezz debt, new money objective, first and foremost objective is to be safe new money, right, with its own safe new return. And the side effect of that is to help original deals. In order to help original deals, they have to survive. At the end of the day, that's kind of the path. If you're sitting on a property that's not at 90%, you can't refi into agency debt, you are still forced to be in a bridge loan, then you don't really have too many options. You got to get to the 90, call it 95% occupancy, execute on that. And then if you can, refi into agency as soon as you can, and then hold the property long enough when the market recovers. But you still need time and money to get to that point where you can actually refi. Or hopefully, if you get the bridge and 18 months from now, the market is meaningfully better, then you could sell, right? You have optionality.
Yeah, I mean that you're absolutely right, and it's the timing issue. And the problem is that was what their intent was early on, and they ran out of money and they ran out of time. So now they're trying to keep the deal going to try to make up for the lost time. I had just to give your listeners an education here, because I had a client contact me. He had been an investor, signed on as a GP in one of these big multifamily guru trainers investments. So he put it in, they made him a GP. And then, 5 to 7 years later, they get notification that the bank is, going to start the proceedings for taking the property back, and they all get involved. They had a cash call. Many of the investors put money in, but there was one guy who was running the deal, and he was part of the upper echelon of that guru's organization. And he was supposed to be keeping his eye on it. He never did. He was always moved on to the next deal and the next deal and the next deal. And so my client looks at this and says, hey, I don't want to lose my money. I want to get involved now and start turning this thing around. And the problem was in the structure of the operating agreement and the ownership, as what does it take to get rid of that guy who was supposed to be managing the property, the asset manager of the property. And it was all drafted in the operating agreement, and it was drafted in such a way that you couldn't get enough votes to get rid of this guy. And so that's something that people need to look at when they're entering into these types of deals. You've got to understand what happens during the divorce. How do I get rid of that spouse? And what's it going to take to remove that person as an operator so that we can get in there and fix the property if we have to? And that was the problem that they were coming up against. I bet there are a lot of people that are coming up against this problem.
Yeah, I just want to give you a little love and appreciation for that point. So what you just described, well, lessons learned, right? We all go back and we now start analyzing what we could have done better on many fronts. Of course, there's two big lessons here. One of the biggest lessons of them all, they should have been capitalized with much more cash to be able to survive unknowns and problems and issues of whatever scale, right? So many deals were just not set up for that. And then the second interesting point is a lot of these operating agreements were written in a really bad way.
Yeah.
So how do you fix it? Well, on a future deals, of course, you learn the lessons. How do you prepare for situations where a manager or co-manager or co-sponsor or co-GP just becomes dysfunctional and they can't perform? In a good case scenario, they'll just literally disengage and say, listen, I can't have the project. I'm of little value. You guys are on the show. I'll just, sign whatever paperwork and be off the deal. And in some cases, if they turn confrontational, then of course you got a troubled deal with the troubled partners, and some of them sink because of that type of a bad arrangement in the first place.
Yeah. Yeah. That's exactly it.
So let's continue the discussion. We have a few more minutes. Just want to kind of see any other really interesting opportunities ahead. I know you talked about hotel conversions to multifamily, and are you seeing this? Because what I've seen, interestingly enough, in that space, just a couple of comments, and I've seen some successful deals, but I've also seen deals where they converted extended stay hotel to these small apartments, and then in those markets, you had new supply that came in. So you have these converted small apartments now competing with the product that they can compete with, so they can't really get the target rents. It's kind of interesting. The new supply problem in multifamily is real in some markets where when the rates were low, a lot of starts took place, and then they delivered it in the worst possible time when the deal started to struggle and the new supply came in, and you got there's actually negative appreciation on rents, and the rents started to soften in some cities and markets, right? So I'm just curious, you're doing new projects very carefully, selecting the right type of property that still makes sense to convert.
Exactly. And okay, so you have touched upon some of the big issues that people don't even think about when you're talking about hotel conversion. I mean, when you're dealing, it's so important to be able to find a property where the market rents are high enough to get the returns for your investor. And that ties into obviously how low you're buying the property to begin with. One of the issues that we've seen in these hotel conversions, there was one big hotel converter. He was a multifamily guy, and he decided he was going to try to get into the hotel conversion business. So we ended up thinking, I'm going to buy 3 hotels in the same submarket, in almost the same street, in a particular city. Well, what ends up happening is when you're done, you've now flooded the market with 550 studio apartments in one area. That's a tough absorption rate to swallow. And that we have never seen that be that successful. I mean, we look at properties between 70 and 125. The one we're doing now is 141. So that's a large size property, but 70 to 25 are typically the right size that we're looking for in these types of properties. And, when you buy them at the right price, and that you can get over, $1,000 a month per unit, those tend to be a great deal, and the numbers look fantastic. So there's a lot of things you need to look at. Primary markets are tough. Secondary markets are much better for these types of conversions. There's usually a huge demand. We're not competing against those types of new construction that you were just talking about, because they're not going into those secondary markets. In order for new construction to pencil out and to get the returns that their investors need, they need to be in a primary market where they're getting top dollar. And many times those new constructions, a studio apartment doesn't make sense for them from a financial standpoint. So they're building more of the 2s, 1s, 2s, and 3s. And so the type of person who rents our units can't afford those new Class A properties. And so they look for our types of properties day in and day out. So it really is finding the right market, getting the right valuation, getting the right price, and then putting the two together. And that's how we come up with our successes.
Yeah, I appreciate that. This is all local, and it needs superb execution. And obviously, example you gave, where it's too much supply in a given market, could be a gigantic problem. So it has to be done very, very carefully. All right, we kind of running out of time, but any final comments, thoughts about where things are going from here? What do you see on it's called recovery path? And the reason, even though the fundamentals are still strong in multifamily sector, for many reasons, one of them being the product not oversupplied. Let's just talk about non-oversupplied markets. Some markets got oversupplied, but that aside, we still have a lot of need for the housing units, especially one thing that most people don't really recognize. We've let I don't know, millions, maybe tens of millions of undocumented migrants into the country, and that's aggregate demand for housing. Think about it, right? I live in New York City. I've seen they build temporary camps, almost like military camps, and there's a lot of folks living in these short-term, I don't even know what they called, temporary housing units, and this doesn't work on a long-term basis. So you have aggregate demand growth that's happening. Plus, U.S. is still one of the most desired places to immigrate legally. So with overall market conditions still being favorable for multifamily, what the recovery path should look like, because we've seen higher for longer interest rates, a lot of pain, maturity cliff, maturity wall, bridge loans that are maturing. But those problems, appear to be temporary. If the Fed does what they just signaled to do, we're going to start moving down. Maybe not as fast as we'd love to, but it's still in the right direction. Is it year and a half, 2 years, and we find ourselves in a much, much stronger market? What do you think?
Mike, you and I are old enough to know we've been through this before. I remember back in 2008, I think, this is just going to be a year correction. This is just going to take, it took a lot longer. So I am not looking at this as being a short-term 1-year fix just because Jerome Powell decides he's going to drop, 100 basis points or something. This is going to be it's not going to be like 2008, but it is going to take longer than anyone anticipates. That's just the nature of the business. I mean, he can change the interest rates tomorrow, but it's not going to bring all the cap rates back down to where they were before. I mean, I honestly think that the whole concept behind free money, which is what was essentially going on beforehand, the interest rates were so low, that is, that's in the past. Quantitative easing has gone, and now we're on the other side, and I don't think we're going to be looking back anytime soon. I honestly tell you, and I don't mean to get political or anything. I think. And this is really, I don't mean to, I'm not trying to pick sides. This is just my impression. If we get Donald Trump back in, I think there's going to be just a change in the mindset. Many people are just tired here. It's almost feeling like the old Jimmy Carter days. I don't know if you were around for that, but it was, bleak. It just felt bleak. And I think getting Trump in there will change people's mindset and make things move. If Kamala Harris gets back in there, I mean, it's just more of the same. And I don't think people are looking for that. That's just my opinion. That's just the way I've seen this before. I kind of take look at politics the same way my father did. The day after a national election, he'd walk into the office and say, "Who won?" And everybody would laugh. But his point was, it doesn't matter. He's still got to go back to work and feed his family. So that's kind of my attitude towards it all. I just think that we do need a shot in the arm. That's the fastest way to get us through these doldrums.
Yeah, I appreciate the comment. I share the sentiment that in general Trump is known to be a real estate guy, right? So if he comes to office, he might bring back 2017, what was called Jobs Act, with the extended bonus depreciation, and he will be viewed as a more pro-business, let's call it real estate, while Kamala will look like Joe Biden #2, and it's sort of that's what it feels like. I agree with that point of view. But I
just think about this way, Mike. Let me just tell you something. As an attorney, we do some estate work in my firm. There's a sunset provision on the estate tax deduction. Right now, the estate tax deduction is over $12 million. 2025, it's supposed to sunset back to $5 million. that means everyone dying is going to be responsible for so much more in estate taxes because of that estate. They keep extending it, but if the Democrats get into control again, they want money. They want assets. They will let that thing sunset, and then it's going to change everyone's perspective, or every wealthy person is going to look and see, hey, wow, I got a big problem now because my tax is more than doubled overnight because of the estate tax deduction sunset. So these are things that you don't think about, but they exist, and it's a real thing.
Yeah, absolutely, it's a real thing, and of course, all those things should be adjusted for inflation, but they haven't been adjusted to inflation. They'll just sunset, and we will be pulled back to what they were many, many years before.
Exactly. Yep.
Yeah,
Exactly.
understood. So, but I'm going back to the one final point, and then we got to wrap up. It doesn't matter who wins. I really don't think that whoever runs the White House is going to make all the difference in the world of business. Of course, there's going to be some big pushes in political agenda, but at the end of the day, most of the I like to compare who's more powerful, the president of the United States versus the Fed chair. And my view, the Fed chair is much more powerful because interest rates are so ingrained in what we do. The cost of money, like you said, used to be free money or low cost money. It's so ingrained into the economics of the investing. And there's more power in Jay Powell's hands than whoever is the president, especially when you have the House and the Senate that can put up a battle, and if you have sort of a split government, you have at least some kind of balance of power. While the Federal Reserve, there is no balance of power. Fed chair runs the Open Market Committee, and they had one dissenting member. If you look at the last meeting, one typically out of a dozen people dissents, and the dissension was let's cut the rates by a quarter versus 50 basis points, because if you cut a 50 basis points, it's going to scare the market. So,
keep in mind,
reach out.
I mean, you and I are about the same age, and in this book, Big Shifts Ahead was kind of dated now. They said people in our generation are retiring with the least amount of equity than any previous generation before us. And you think to yourself, why? Why is that the case? What is different about our generation than everyone else? And it's very simple, and it makes total sense. We are the first generation that has lived our entire life off the gold standard. And we have been subject to more economic upheavals, more economic cycles than any other generation before us. And that has created a lot of problems. And it ties into the Fed, and somebody's in control because we don't have a standard.
Yeah, I appreciate that. That's why gold and silver, precious metals are going through the roof, because ultimately there's a concern that the government will keep printing money.
Yeah.
So what's the best way to reach out? How would folks reach out if they want to work with you, ask you questions, etc.?
All right. Well, what we can do is you can reach me at charles@dobinslaw.com, or we're just switching over. It's charles@dac.law, DACC.law. That's one way you can email me. I represent, my specialty is really on the multifamily side. I love representing people buying properties and taking them through the whole acquisition process. We don't do securities work, but we tie in with a great securities firm to make sure that you're doing everything correctly. And also the Multifamily Investing Academy is my educational arm, and that's MultifamilyOS.com, and that's how I teach you the business of multifamily ownership, which is I still believe is the greatest business in the world to be in. So that's it.
Thank you, Charlie, for your wisdom. Thank you for sharing, and appreciate you coming on a podcast. Thank you so much.
My pleasure. It was a lot of fun. Always good to see you, Mike.
Likewise.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike's slot name. Keep listening and keep investing Big Mike style. See you on the next episode.